Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City. When you're buying a home, there are closing costs that both the buyer and the seller has to pay. There's some that are required in our state for the seller. There's some that are typical, what we call typical expenses for the buyer. But there's also a middle ground, which is a negotiated amount. Now, depending on whether you do an FHA or VA or conventional loan, this allows you to, say, take a $150,000 or $200,000 property and ask the seller to pay for 3 to 6% of your closing costs. So, for instance, if that's $200,000 on a VA loan, then you can get the seller to pay up to $12,000. That can be in terms of your reimbursement on things, or it could be points to lower the interest rate, or your taxes and insurance prepaids. So it's really can be a really, really good program for someone who doesn't have a whole lot of money. But here's the question I always get asked, especially in terms of first-time buyers: who really pays the closing costs? So in other words, if you ask for $5,000 of the seller for those extra closing costs, is the seller actually paying for that? Well, I guess you can make an argument that that's true, but I'm going to make a totally different argument to say that you pay for closing costs regardless. Because of if you pay just down payment and normal closing costs, you don't ask for anything, you are obviously paying closing costs in terms of cash out of pocket to pay for 12 months of insurance plus your escrows, plus your tax escrows, plus your appraisal, etc. However, if you're asking for the seller to pay $5,000 to $10,000 extra of your closing cost, I would maintain you are still paying for those closing costs. Very simply, it's because you're paying $5,000 to $10,000 more for the house, because a seller looks at net. You can be at a higher price than what you're willing to pay for the house, but some other offer may come in that nets that seller more, and so they're going to go with whatever nets them more. So essentially what you're doing is you're building it into the mortgage. And right now, if you've got a 3.39% mortgage over 30 years, that's not necessarily a bad deal. But it also leads to the final question: what's the right thing to do? And for that, there's really no simple answers. And what we'll have to do is do some individual counseling. If you're a first-time buyer and you've got student loans and you don't have a whole lot of furniture, but you realize that you're going to be paying double for rent what you could possibly actually buy a home for in a monthly payment, I'm probably going to tell you that, I'm going to recommend that you have the seller pay that closing cost. It's still subject to appraisal, so it's got to appraise with those closing costs built in at that higher price. But you really don't have the money or the reserves or the fact that you're going to be acquiring things to live in that house to go ahead and pay that extra $5,000 in cash. However, if you do have that money, you have a lower price that you're paying for the house. You have more equity that's built in. And so there's various ways to look at this. And so individually, we'll decide or help you to decide what's the best thing to do. Is it best to keep your capital in reserve and have the seller pay for the closing costs? Or if you have the money, is it better for you to do it? We'll take it on an individual basis. But basically, one way or the other, you're either paying cash for the closing costs or you're building it in and paying a higher price and getting a higher mortgage. Most important thing is, what is best for you? This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.